Okay, folks, time to get started. Reminder again, if you haven't picked up your quiz, please do so right after class today at 5 o'clock today. I'm going to take the quizzes in, leave them in my office until the spring break is over. Because if I leave them out for 10 days, God only knows what will happen to them in the 10 days. So if you don't want your quiz, I don't care, right? So it's up to you. But I'm just saying, if you want your quiz, you want to check it. I think it's a good idea to pick up your quiz, even if you're in denial. And just check to make sure I haven't screwed up on a grading issue, right? You will never know if you don't look. And let's face it, just because you don't pick up the quiz doesn't mean it's not there. This is some kind of an existential, what is it, Schrodinger's cat kind of thing. There's no Schrodinger's quiz, which is right. It doesn't disappear just because you don't look at it. So my advice is pick it up, look at it, throw it away if you want to. It's your worst quiz goes away anyway. This is your freebie. You used it up, at least it's done. The second is, I know it's a spring break, you have big plans, you're probably not going to study, but when you come back, as I said, the crap is going to hit the fan. So if you haven't picked a company, please do. If you picked a company and you haven't entered the name in the master list, please do. If you picked a company and entered in the master list, not started your valuation, please do. You started the valuation and kind of gave up on it like 2 weeks ago, please pick it up again. So all logical things to do, but logic often goes to the back of your head when spring break approaches. So now, because I give you that one-time freebie deal, which, for feedback, it's got to be by the end of March, so try to get your first shot. Okay, so today we're going to complete our discussion of terminal value. Okay? And the first question I'm going to ask you is a question that I already answered last week, but it's something that I want you to be prepared for, because as I said, a lot of the people who value companies, and they're going to be your colleagues that you work with a year or 2 years from now, are going to still use this exit multiple strategy. So I want you to give me the reasoning for why it's wrong to do an intrinsic valuation with an exit multiple. Just summarize back for me what we talked about last week. What's the reason? Why? Why should you not use an exit multiple to come up with the terminal value?
With multiples are on the basis on pricing, and terminal value we are seeing on the basis of cash flows that are intrinsic values.
Philosophically, it doesn't make sense, right? Pricing is pricing, intrinsic valuation is intrinsic valuation. Bring them together. I'm not sure what you have. So you can use liquidation value, you can use a perpetuity, you can use an annuity, you can use all kinds of assumptions when you get to year 5 or 10, but you cannot use a multiple. You want to use a multiple, just do a pricing. Make it a forward pricing. That's all it is. And call it a pricing. Don't call it an intrinsic valuation. So yeah, go ahead.
If we were to go to firms that that's their standard protocol.
And do the kabuki dance.
Okay.
Right? The kabuki dance is, you'll call it a DCF. You'll play the kabuki dance with your colleagues, with your clients. the reality is in your heart, you know, you've done an intrinsic valuation. So in a moment of honesty or when you're drunk or whichever, the two might coincide, call it what it is. It's a forward pricing, which is what all banking DCFs are. They're forward pricing. I call them DCFs in drag, right? Basically, you distracted me with the cash flows in year 1 and 2. And while I'm distracted, you slip 8 times EBITDA into the terminal number. So don't look at that number. The reality is 90% of your value comes from that pricing. So there's nothing wrong with pricing. Let's stop being dishonest and labeling pricing as DCF. You know how much time and stress this would remove from bankers if they admitted to the fact that they're doing pricing? Because it'll take all the kabuki dances you do of, we have to stay busy, we have to project cash flows. And my question is, why are you wasting your time? It's a forward pricing, just call it a forward pricing and do it better. In fact, later in this class, we're going to talk about how to do pricing better. In my view, the problem with pricing is because you don't label it as pricing, you're not doing the things that make pricing better. So let's move on to this issue of perpetuity. Let's assume I have a company with $100 million in after-tax operating income, which is expected to have zero growth in perpetuity. Remember, I said we can have a zero growth rate in perpetuity. And it has a cost of capital of 10%. What's the terminal value of this company? What does it look like I haven't given you? I've given you earnings, right? I've given you no CapEx, no depreciation, no working capital. What is it about the way I've described the company that makes those numbers unnecessary? What's the clue here? Because usually you need cash flows, right? You need to subtract out net CapEx and change in working capital. It has no growth. Because it has no growth, it has no reinvestment. If it has no reinvestment, after-tax operating income becomes free cash flow to the firm. You divide it by 10%, your value is $1 billion, right? So let's say you're the analyst, you come up with $1 billion. Your managing director says that number looks too low. Can you make it higher? Well, what if I raise the growth rate to 2%? So I have a generic question. It's going to sound like an oddball question because the answer seems obvious. If I take the example that I just gave you and increase the growth rate to 2%, what will happen to your value? I'll give you the choice. Go up, go down, nothing will happen, or it depends. In which case you have to tell me what it depends on. At first sight, what does it look like will happen if you increase the growth rate? It'll go up, right? In fact, the math is, in fact, if I ask you what the value will be, you take the 100 divided by 0.10 minus 0.22. This is magical. You added $250 billion in value, 250 million. What am I missing when I do that?
The cost of creating that growth.
In other words, 100 million came from assuming that I didn't have to reinvest. Now you put in a growth rate. So I need to give you the information to be able to estimate how much you need to reinvest, which means 100 million will get lower. And how much lower it gets will determine whether this is going to add value. So today we're going to focus on what I think is the key assumption in terminal values. It's not the growth rate. It's what you're assuming about returns on capital in perpetuity that is going to determine whether growth increases value or decreases value. This is why when you get this angst about, oh, the growth rate, I'm moving it from 2 to 3% of my stable growth, my value is jumping all over. Your value is jumping all over because you're changing just the growth rate and leaving everything else unchanged. Of course, your value is going to go up. You created a magic fountain right in the front of your company, and every time you want to increase the growth rate, and nothing else changes. So today we're going to focus on those mechanics, but I want to start with that question of growth rate in perpetuity, because we did it towards the end. And I want to make sure everybody is, again, comfortable with this. First, with the notion of your growth rate cannot exceed the growth rate of the economy forever. The reason I bring that up is I got at least a dozen emails from the two classes put together on why somebody's valuing a company, which is going to be the exception to the rule. I'll give you a few examples of the kind of pushback I got. You take a company like Apple. How long has it been able to grow at above the growth rate of the economy? 30, 40 years, Microsoft. In fact, if I ask you to name companies that have been able to grow for long periods, there are companies that have grown for 30, 40 years. First, 30, 40 years is not forever. But clearly there are some companies that grow for longer. And the question that's implicit there is, why can't I let my company have 40 years of high growth before I put my company to stable growth? You can, right? But the very fact that we can name these companies that have been able to grow at high rates for long periods tells you what? That they're the exception, not the rule. If you value your company to be an exception right from the beginning, where's the upside for you as an investor? Basically, you're giving away the game at the start, and if your company is just a great company, not an exceptional company, it's a negative surprise. You need to keep something for yourself. So even if your company is special, there's nothing that prevents you from giving it 20 years of growth or 25, but the longer you stretch growth out, the more you're giving up upfront, and the more you then are at the mercy of expectations changing in the company not delivering. It's like signing a 21-year-old to play center field because you have lots of potential. He said he's going to be the next Mickey Mantle. Scott Boras convinces you to pay $500 million for the next 15 years. On an expected basis, I'm signing an exceptional player. The only thing you can have is disappointment, right? When you've signed a player and said, this player is going to be the greatest player of all time, if he's only the 5th greatest player of all time, you got to lower the price. You paid too much. So there's nothing wrong with allowing for longer growth periods, but that doesn't mean you can break this rule. Somebody else, I think in my undergraduate class, said, what if I let the growth rate be just a little bit higher than the growth rate of the economy? And I said, that's like being a little bit pregnant. This is either 0 or 1. You're either pregnant or you're not, right? You can't just, this is one of those rules you can't break. You can't just say, well, can I just nudge it up? Because that's a dangerous game. You go 2.05, then you go 2.07, then 2.10. You're going to start playing with the growth rate till you get the number you want. My advice is just leave it alone. Cap it at the growth rate, the risk-free rate. And if you want to reward your company for being a special company, lengthen out the growth period. I'm not stopping you from using 20 years, but don't mess with the growth rate in perpetuity.
Professor,
Yes.
when we're using 10-year treasuries in a 10-year risk-free rate in our discount rate.
Yeah. Can you change that rate when you get to year 11? Absolutely. Yeah. In fact, if you look at the FCF Ginzu spreadsheet, one of the questions I ask you is, do you want to change the risk-free rate after year 10? I'll tell you why I put it in. During the last decade, what was the lament you heard, especially from older hands? Rates look too low. I said, don't mess with the rate today. It is what it is. But if 10 years from now, you tell me your rate, the rate's going to go up to 4%, you can raise it, but when you raise the rate, you're also going to raise your growth rate, right? And the net effect is surprisingly small because everything changes when you change that risk-free rate. So it's absolutely okay. You can say year 10, I'm going to assume that the risk-free rate is going to be lower or higher than it is today. And then make sure your growth rate in perpetuity is tied to that risk-free rate.
Consistency throughout.
Exactly. It's the consistency. That's it. You can get the risk-free rate and the growth rate wrong, but if you're getting them wrong in the same way, they basically cancel. It's the R minus G in the denominator, right? Both go up or both go down. So, which brings me to the question of negative risk-free rates, which is kind of a so if you remember the last decade, there were currencies, and you saw them in the chart where the risk-free rate actually turned negative. And when that happened, people freaked out. I remember Anna saying, you can't do discounted cash flow valuation with negative risk-free rates. My question was, why not? And you know how the reasoning went, right? If you have negative risk-free rates, your cost to capital is going to be really low. So complete the story as to why DCFs are not going to work. If you lower the discount rate, your value is going to go through the roof. You're going to overvalue everything. So in response to that critique, I said, okay, I'm going to value a company in an economy with negative risk-free rates. So this is a valuation of Heineken I did in September of 2019 to a European audience that was very fixated on negative risk-free rates. I start with a negative risk-free rate, minus 0.5%, and not surprisingly, I end up with a really low cost of capital. So that's a good news. But think of what a negative risk-free rate is signaling about the economy. A negative risk-free rate also goes with deflation or really low inflation. So you're not going to be able to raise prices like you hope to. And it also goes with a slowing economy. I said those same forces have to play out in my cash flow. So when I projected the growth rate, I gave them a 3% growth rate. It's interesting because there were, I think, 3 people in the audience who were actually from the Heineken Finance Group. And they gasped 3%, you know, that's a really low growth rate. I let it go. Then I got to stable growth and I really shocked them by giving the company a minus 0.5% growth rate in perpetuity. They said, that's not fair. I said, you weren't complaining when I used a minus 0.5% risk-free rate, right? What one hand gives you, the other hand will take away. When you have really low or negative risk-free rates, your growth rates have to stay in sync. And the value that I got was actually, I think 60% of the actual stock price. I said, look, just because risk-free rates are low, I'm not going to get a sky-high value. You know what will give me a sky-high value? Is if I use a negative risk-free rate to come up with my cost of capital. But then when I get to the growth rate in perpetuity, I look at the historical 40-year nominal growth rate in the European economy and use a 3% growth rate forever. The problem there is I'm assuming different economies in my numerator, and that's causing my valuation to blow up. In contrast, if you're valuing a company's Turkish lira, the discount rate is going to be huge, right? The risk-free rate is 13, 14, 15%. Your growth rate can be really huge as well, 10, 13, 14, 15%. And guess what? Your valuation is neither going to blow up nor implode because you've tied the two together. So that's the first stop. When you think about growth rate in perpetuity, don't think too long because let's face it, none of us knows whether there will be a 2032. Who knows? Climate change might kill us all by then. Depressing thought. So we're making an assumption about things we don't know. The only thing we can do is stay internally consistent. If it really bothers you to use a negative risk-free rate, do what Ed suggested. Change the risk-free rate after year 10. Make your growth rate 3%, but then make sure your risk-free rate is also at least 3%. Then you're staying consistent, your valuation will still work. So let's talk about the second thing in terms of value. And this is, I think, something I've already suggested when you sit down and look at a company. So how long will high growth last in my company? A little later in this class, I'm going to show you a graph, which I think is one of the most depressing graphs to look at if you're a growth investor. And that graph comes from a study that looks at how long growth lasts at IPOs. Because let's face it, IPOs go at the peak of growth, the revenue growth is much higher than the sector. And this study did something very clever. They took IPOs, they looked at the revenue growth of these IPOs. At the time they went public relative to the sector, and then they track what that growth rate looked like 1 year later, 2 years later, 3 years later, 4 years later. And what they were trying to figure out is how quickly does growth converge in the sector? Kind of a rough measure of how long does growth last in a typical company. You know what they found? By the time you got to year 4, you could not tell the IPO company from the rest of the sector, the growth that converged in the sector. For most companies, growth fades quickly because there are no barriers to competition coming in. So when you look at your company, say, how long will growth last at my company? Rather than think of a number, I want you to think about the company's competitive advantages. What are the barriers to entry? And here's a clue. If you cannot find one competitive advantage this company has, give it a very short growth period. I remember valuing Groupon when it went public. And at that time came in with this high growth rate, superstar status. Then I started, what is special about Groupon? The only thing I could think of is they got my email first. That's all I could think of. And I said, well, a dozen other companies are going to come in with deals of the day. And this was before the Amazon deal of the day, et cetera. I said, I don't see a competitive advantage here. I'm not going to give them 10 years of growth. I'm going to make the growth go in 3 years. And I overestimated how long they could grow because this was a company with almost no competitive advantages. If you have strong competitive advantages, that can be sustained. 2 parts to it, right? You can have a strong competitive advantage that's going to slip away because it's technological, or it's based on a person who can get hired away. Then I'm going to be a lot more cautious. But if you have strong and sustainable competitive advantage, something you know has a history of lasting, then I'm going to build in a much longer growth period. We had this brief discussion of brand name that we returned to. And one of the ways I characterize brand name is, whatever the mystery it is that creates a brand name, we know that historically it's one of those competitive advantages that seems to last a really long time. Doesn't mean you can't ruin a brand name. I remember Quaker Oats essentially kind of pushing its brand name value to 0 before rediscovering it. So the stronger and more sustainable competitive advantages, the longer you can have your company grow at above. Because remember, it's not growth per se that creates value, it's whether you have returns that exceed the cost of capital. That's a competitive advantage. So when you ask the question, how long will growth last? Keep that in mind because it's something to factor in. Third, just because you're getting to the terminal value, don't forget all the things we talked about in the context of growth. We said to grow, you have to reinvest. And in terminal value, this becomes critical. You can be sloppy in year 1, 2, 3 and talk about efficiency growth, but now you're talking forever. So when you say, I want to grow, I'm going to ask you, how much will you need to reinvest? When I described the sustainable growth equations, I said they weren't useful in most companies because returns are changing, margins are changing. But I'll tell you where they become really useful. You get to the terminal value stage, sustainable growth equations have to hold. In other words, your growth has to be tied to return on capital and reinvestment rate because efficiency is now gone from the picture, right? You can't be improving returns on capital in perpetuity. So to estimate my reinvestment rate in perpetuity, all I need to do, and I'm making it sound simpler than it is estimate what kind of returns on capital your company can make forever. A part of you saying, but tough enough time figuring out what their return on capital was last year. You're asking me, what will the return on capital look like in 2032? I'll simplify the process. If your company is in a competitive business, like what automobiles, apparel, retail, 80% of businesses in the world, it's tough to earn more than your cost of capital. You look at the sector. In fact, you could go to my website. I tell you what percentage of companies in each sector earn more than the cost of capital. If you're in a business where it's difficult to earn more than your cost of capital, when you get to year 10, you know what the safest assumption you can make is? Assume the return on capital will be equal to the cost of capital. In other words, your value creation days are done. You can keep growing, but you're going to be earning your cost of capital. For about maybe 75% of the companies are valued, that's the default built into your spreadsheet. If you tell me nothing, if you don't change that default, I will make your return on capital go to the cost of capital, because for many companies, that is the case. And if your return on capital is equal to the cost of capital, something magical happens. Take a look at this table. What I've done in this table is estimated what your terminal value will be as a function of the growth rate in perpetuity. This is a variation on the example we did to start the class. So I'm changing the growth rate from 0 to 3%.
Professor, we're not able to see the slides on Zoom.
It's in the projecting the right size.
Can you see it now?
Yes, thank you.
Yes.
So if I change my growth rate, I want to see what happens to the terminal value. The cost of capital for this company is 10%. If I set the return on capital at 10%, take a look at what happens to my terminal value as I change my growth rate. Nothing happens. Whatever I gain by using a higher growth rate, I lose because I have to reinvest. This isn't rocket science. If I earn my cost of capital in capital budgeting, what kind of net present value do I get on my projects? For a project that earns its cost of capital, 0. So how much value do I create by taking a project 0? What if I take 100 projects? 100 times 0 is 0. The nice thing about the 0 times any number is it's always 0. So once you make that assumption that return on capital is equal to the cost of capital, you don't even have to think about growth rate. You might as well use a 0% growth rate. I wrote my first valuation book in the late 1980s. John Wiley was the publisher. And at the same time that my book came out, John Wiley also published a book by McKinsey. Some of you might have seen the McKinsey valuation book. It's widely used out there. So both the books are published by John. And the original McKinsey edition of the book, which for the first 5 or 6 years was written by Tom Copeland and a couple of other authors. Now it's written by a committee of McKinsey consultants. The original few editions, I don't know whether it's changed. Here's how McKinsey did the terminal value section. They had what they call NOPLAT. You're saying, what's NOPLAT? It's EBIT times 1 minus T. It's the after-tax operating income divided by cost of capital. There's no growth rate there. And I'd get these emails at that time, not emails, but snail mails from people saying, I'm looking at the McKinsey book. There's no growth rate in the terminal value equation. Can you tell me why? To which my response is, why aren't you writing to McKinsey? Why are you writing to me? But I guess they wrote to McKinsey, didn't hear back. You know why McKinsey made that the terminal value? Because McKinsey also made an assumption that if you have a mature company, it cannot earn more than its cost of capital. The reasoning actually is impeccable, that no company has barriers that last forever. So you're in perpetuity, I'm going to assume return on capital is equal to cost of capital. And if you make that assumption, guess what? It doesn't matter what growth rate you use. You might as well use a 0 growth rate. But McKinsey's own research suggests that can be a dangerous assumption to generalize. There's a publication from McKinsey called McKinsey Quarterly. If you go to the McKinsey website, you sign up for it, it's free. You can actually get it. It's a very good publication in terms of pragmatic research that we use in corporate finance and valuation. And one of their papers, they actually looked at companies and what happens to companies as they age. And the results actually cut against what they're asking us to do. I'll start with the news that's consistent with what we do. As companies age, when they look at the growth rate starts to decrease, approach towards a growth rate of the economy. That's basically what we've said. But when they looked at the returns on capital, they discovered that returns on capital are sticky. That you take a company like Coca-Cola, you track its returns on capital over time, they stay high, which means there are some companies at least where you can assume the return on capital is going to stay above the cost of capital. Why? Because they have strong and sustainable competitive advantages. If I'm valuing Aramco and I'm putting in a terminal value at the end of year 10, I'm bringing the return on capital down to cost of capital. Because the advantage they have is you stick your finger in the sand in Saudi Arabia, oil comes out. Everybody in Canada, you got to dig 5,000 feet, you got to unfreeze the oil, you got to bring it out. You start off with an incredible competitive advantage because it costs you $3 a barrel to get the oil out. It costs everybody else $15 a barrel. That's not going to disappear after year 10. So if you have something like that, it is okay to leave the return capital above the cost of capital. But do it only for companies where you think it is a reasonable assumption.
You've done it on industry basis. It sounds like each industry will have a very specific.
And that's why I actually report return on capital and cost of capital by industry. So take a look at what those numbers look like. For technology companies, I routinely leave the return capital above the cost of capital. Yeah, because it looks like even if you capitalize R&D, that technology companies have this excess return that's long-term. Now, sectors like automobiles, the entire sector earns less than the cost of capital. So do look at industry averages, look at the return on capital and cost of capital. So when I ask you, what will the return on capital be beyond year 10? That's what you should be thinking about. What are my competitive advantages? How long will they last? Now, there are a lot of bad practices in valuation. And once they get embedded, they never leave. Now, so one of the things you would run into is there are people who value companies when they get to stable growth will make the following combination of assumptions. You tell me where in this combination I have a problem. First, they would say it's a mature company. So I'm going to let CapEx offset depreciation. It's, I think, hard coded into some valuation reports. CapEx offsets depreciation in stable growth. Okay. So what's your net CapEx going to be? CapEx offsets depreciation, net CapEx is zero. There are no working capital requirements. Okay, this is getting even better. Change in working capital is zero. This is another advantage of zero numbers, right? 0 plus 0 is 0. And 0 divided by any number is 0. So basically, you end up with a reinvestment rate of 0. You think, what's wrong? Now comes my final assumption. I assume that my company will grow 2% a year in perpetuity. They're very selectively following the rules. The growth rate is below the growth rate of the economy. But you see the problem, right? If you don't reinvest, how the heck are you going to get the 2% growth rate? So I'm going to hit you with the argument they will use. My company is growing only at the inflation rate. You see where this is going, right? The inflation rate, I don't need to build fresh capacity. I don't need to build fresh factories. I just have to sell the existing units. So why can't I assume no reinvestment if I'm just growing at the inflation rate? Why can't I assume no reinvestment? Seems like a pretty reasonable argument, right? So what does net CapEx mean? Basically replacing existing machines with new machines, existing equipment with new equipment, right? That's what. So if I'm assuming a 2% inflation in my revenues and my earnings, shouldn't I be assuming that that equipment is going to cost me more? In other words, I can't selectively look at inflation when I do my revenues and forget about the fact that inflation is going to, if that were not the case, you know what should happen to the returns of capital of companies as they age? They should go towards infinity, right? And they don't. Put simply, there is no escape hatch here. You put in a growth rate, I'm going to ask you to reinvest, whether it's inflation, below inflation. And the only question you've got to ask is, how efficiently can I deliver that growth? And maybe by just replacing existing equipment, you can get a 25% return on capital rather than a 10%. And I'm okay with that. But there is no way you can assume zero growth, a positive growth rate and a zero reinvestment rate. And finally, when you get to stable growth, you're 10, you're 11, you're 15, you're 20, you're making your company a boring company, right? Boring company, why? Its revenues have grown, its margins are nice positive numbers. Hey, make it a boring company, give it the benefits of being a boring company. You think, what are the benefits of being a boring company? What's the biggest benefit of being a boring company? Your risk should come down. You should be able to borrow money. Boring companies have lower cost of capital. One of the things I've never understood in DCF valuation is people who insist that you get a discount rate up front and that you can never change it. So I know some of you are valuing young, high growth, money losing companies. What's your cost of capital looking like right now? Yeah, high number, right? You have no debt, your probably equity is risky, maybe a 15% cost of capital at the upper end of the spectrum, the 80th percentile. When you start, tell me what you're doing to your company on your spreadsheet. You're making your small revenues into big revenues. You do it so effortlessly, right? With a 40% growth rate. You're making your losses into profits as you make the target margin positive. I'm okay with that. But if your assumptions about revenue and margins come to fruition, you know what should happen to your cost of capital? It can't stay at 15%. It should converge on the cost of capital of a mature company. Here again, I'll tell you what's built in as a default into the spreadsheet. When you get a steady state, I push your cost of capital towards the average for the market, not even the average for the sector, because who knows what you'll diversify into. You can override it, but think about it. You want to leave it at 15%. If you leave it at 15%, I guarantee you no young growth company will ever make it through your threshold. Because here's what you're doing. You're making a mature company and giving it the risk of a young growth company. It's internal consistency. It's consistent to your own assumptions. So when you make your company a mature company, give it a cost of capital that resembles that of a mature company, give it a reinvestment rate that reflects its lower growth rate. The company has the same name. Tesla in year 11 has the same name as Tesla in year 1, but it's a very different company, right? It's a company with $400 billion in revenues with a 20% margin. 20% of $400 billion is an $80 billion operating profit company. Make it one of the most profitable companies in the face of the earth. It'll be very different than the company today. Yes.
When you say that you always need to be reinvesting capital in the company, is that basically?
No. Did I say that? I said if you want growth, I said you need to reinvest. So it's a statement that's conditioned. So if you want to have no growth, then I'm okay. Don't reinvest. But if you want growth in perpetuity, you got to be adding to your capital base, right? And that adding to the capital base might just come from replacing existing equipment. But remember, you're replacing it at a higher cost than you bought it at 10 years ago. So it really, the two statements to go together. So you can get away without reinvesting. You can get away with growth, but you can't get away by assuming the two in the same company.
What if the company is like generating capital, reinvest the proceeds to that? So like it's not like new capital like from shareholders. But
that's what reinvestment is coming from. It's not coming from outside. It's actually coming from internal earnings. I'm taking a portion of your earnings and putting it back, right? So it's always reinvest. In fact, in stable growth, you shouldn't be going outside. If you're going outside to raise capital, reinvest in stable growth, there's something terribly wrong with your company because it needs to be self-sustaining by that. So last thing I want to do in intrinsic valuation is bring all the pieces together. So let's see the pieces we went through. Started with discount rates, right? Spent a lot of time on that. Then we went to cash flows, measuring free cash flow to the firm, free cash flow to equity. Then we talked about growth rates and looking historical, analyst estimate, fundamentals. And then we closed with terminal value. Those pieces all go in. So when you think about every discounted cash flow model, you're going to see all four ingredients. So I want to talk about how you decide which ingredients to pick in your valuation. The first choice you have to make is, do I want to value just the equity in my business or value the entire business? Remember we talked about this at the start? And at that time I said, if you do it right, you should get the same value of equity either way. So the answer to which one should I do will depend on whatever's easiest, whatever's more pragmatic, whatever you can do easier, pick that path and stay consistent. With one exception, if you're valuing a bank, you have only one choice. You can value only the equity. You can't value the operating assets of the bank. There's no such thing. So if you're not valuing a bank and you face this choice, it really becomes which is easier to do. So let's trace each one through. To value the equity in a company, I need free cash flows equity, right? Which is post-debt cash flows, and I need a cost of equity that reflects the leverage in my company. To value the firm, I need free cash flow to the firm, which is a pre-debt cash flow, and a cost of capital that reflects a mix of debt. And if your debt ratio is stable, you know what? Both are equally easy to do. I can do free cash flow to the firm, but remember the free cash flow to equity, I gave you that shortcut to get to free cash flow to equity, where if your debt ratio is always 25%, you could just take 75% of your reinvestment. So here's the short answer. If you have a company with stable leverage that's never going to change, free cash flow to equity valuation is just as easy as free cash flow to the firm. And it's more intuitive, because when you buy shares, you actually get free cash flow. But in most firms, you're going to feel either that there's a sense of direction. The debt ratio is low, it's going to go up as my company gets more mature, or it's too high, they have to bring it down to get to steady state, or you just don't know. You know it's changing, but you don't know in which direction. If that is the case, it's easier to work with free cash flow to the firm and value the firm than to value equity. Let's think about why. If you have a company where the debt ratio is low and it's going to increase over time, to estimate free cash flow to equity, I have to estimate debt repayments and debt issuances. Remember those two lines? It's a pain in the neck because you're sitting there saying, what will it be? How much will the debt? There's almost a circularity here because to decide how much debt you got to raise, you got to estimate the value. Estimating free cash flow to equity gets really messy when debt ratios are changing. So when debt ratios are changing, just go with free cash flow to the firm. The cost of capital is easy to adjust for debt ratios. Just change the mix of debt and equity. So 90% of my valuations end up being firm valuations rather than equity valuations. It's not because they're better, but because I'm lazy. I'm looking for the path of least resistance. And to me, this is the path of least resistance. Why ought to be estimating 3 line items, which are wasting my time, and they really don't make that much of a difference to my bottom line in terms of value equity. Now, within the context of valuing equity, you have a choice of, so you use equity valuation when leverage is stable, firm valuation when it's unstable. Within the context of equity valuation, though, I can discount dividends or I can discount free cash flow equity. I'll make this really easy for you. If you can estimate free cash flow equity, always use it. Why? It is more comprehensive. It's not constrained by what companies actually do. You actually estimate what they can pay out. It's a potential dividend. If you cannot estimate free cash flow equity, really you have no choice, just discount dividends. This is how we end up with the dividend discount model to value banks. It's not because the model magically works better, it's because we've given up. We've tried to estimate free cash flow equity for a bank, and after a while we throw up our hands and say, this is too messy. I have no idea what the net capex and change in working capital is here. So let's say each fork of the road, equity valuation or firm valuation. For most non-financial service companies, firm valuation is going to dominate equity valuation. Within equity valuation, dividends or free cash flow equity. Well, if you cannot estimate free cash flow equity, it's really not even a choice. You're going to go with dividends. But if you can, you're going to go with free cash flow equity. And that's always terrified me about banks. We're stuck with these dividends. And we know that banks don't always pay out what they can afford to in dividends. So later in this class, I'm going to revisit that question, especially post-2008, and talk about, can we estimate free cash flows to equity for a bank using something else? Because the traditional way of net capex and change in working capital is not going to work. Now, what discount rate should you use? You pick a cash flow, the discount rate comes with it, right? It's like they're locked at the hip. You decide to discount dividends or free cash flow to equity, you're going to have to use the cost of equity. In what currency? In whatever currency you estimated the cash flows in, real or nominal, it depends on what they did. So by the time you're done with estimating the cash flows, the discount rates kind of pick themselves. You're valuing free cash flow to the firm, use the cost of capital. So as you look at these choices, step back and say, hey, ultimately I want to value for the equity. What's the most pragmatic way of getting there? Because it's not that one is right and the other is wrong. It's as some of these approaches take more work, especially when leverage is changing. So if you bring it all together and you think about this final step, what kind of growth can I expect from my company? For some of your companies, you might hit pay dirt, at least in terms of work you have to do. If you're valuing a company that is already a mature company, and we know what we're going to look for to see if a company is mature, right? First, you're going to check the growth rate. Is it growing at less than the risk-free rate. So if you have a company, so let's say it meets certain criteria, it's growing at 2% a year. Con Ed, good example of a company. It's not going to grow at 12% a year. It's a mature company, 2%. But that's not all. You're also going to check to see whether it's behaving like a mature company. What does that mean? It's not reinvesting huge amounts. If you're reinvesting huge amounts, for better or worse, you can't put it in as a mature company because it seems to believe that it can have growth, correctly or incorrectly. You're going to look at the reinvestment rate, you're going to look at the growth rate, you're going to look at the risk of the company. Everything has to converge. So if you have a company with the cost of capital close to that of the market, has a reinvestment rate which is low, reflecting the growth rate, and a growth rate less than the risk-free rate, you need only 3 inputs to value the company. You don't need 10 years of forecast, right? You need expected cash flow next year, which you might build off today's cash flow. You need a discount rate and a growth rate. Your terminal value happens right now. Terminal value doesn't have to be in year 10 if you're already a mature company. You're going to be done in 5 minutes. Don't go looking for trouble. If your company can be valued with 3 inputs, why go looking for 30 inputs? Let's move one step up the ladder. You're valuing a company like Coca-Cola. You think there's, or Levi Strauss. It's already a mature company, but it has some growth left because there's some part of the world or some product they've introduced that's going to give them above economy growth. Remember, that's not a high threshold to beat, right? If you're growing at 6%, you're not a mature company yet. But you're pretty close to the growth rate of the economy. So here you can use what are called two-stage models. In two-stage models, what you do is you assume a 6% growth for the next 5 years. At the end of year 5, you move it to 4%. It's not much of a transition, so you can make it in 2 stages. But let's say you're valuing a company like Snowflake. Software company, you think there's lots of potential, 50% growth for the next 5 years. You definitely can't use a 2-stage model, right? Because you go 50% and go to 3%. Now, see what happened in year 6. You don't fall off cliffs like that. So you have 50% growth for the next 5 years, and you want to make your company a mature company, you want to create some kind of a transition. That's just a fancy word for it. You need to get from 50 to 3 over a period of time. What are 3-stage models? My FCF of Ginzu, if you have a mature company, basically all you have to do is put the growth rate close to the growth rate of the economy. Even though you have a 10-year forecast, you're valuing basically as a mature company. So it's flexible enough. You can make it 2-stage, 3-stage, whatever you want to do. But essentially, those are the parameters that drive what your ultimate discounted cash flow valuation is. Yes.
Why is 10% like the benchmark for like choosing between 2 stages?
I had to pick a number. I mean, it's you can make 8%, 9%. It has to be close enough to the risk-free rate that a drop is not going to shock somebody, right? So you could say, well, no, even at 10% is too high. I'm going to go in 3 years to 4%. Perfectly okay. But I'm saying there's a threshold you have to decide where to drop. I mean, think of it in terms of shock value, right? If I showed this growth rate to somebody in the business, would they be shocked by the change in a year? And the answer is yes, you probably want to build in a transition. So ultimately, every discounted cash flow model you see out there, I think of it as like playing with Lego, right? You got the cash flow Lego box, you got the discount rate Lego box, you the growth pattern Lego box. You're putting them together, you got a DCF model. So the Lego that you pick out of the cash flow box is a dividend Lego. Then the only Lego that will fit from the discount rate part is the cost of equity Lego. I don't think they make Legos like this, and I might be violating some patent by using the word Lego. But basically, I'm saying when people claim they've invented a discounted cash flow model, the answer is, what do you invent here? It's a combination of cash flows, discount rates, and growth patterns. But people try. I know Sanford Bernstein, which is well-regarded research firm, patented a dividend discount model. They actually patented it. They went to the patent office. What exactly did you patent? Did you invent the word dividends? Is the discount that I should be paying? It's people patent all kinds of things. There's nothing new about discounted cash flow models. There's different combinations. You can give them a name and put your name on top. The H model. I've seen discounted cash flow models with people's names attached to them. I think that's magical. Just a different pattern. There's really nothing here that you can think of as new and original. It's just basic common sense and being consistent. Yes, sir.
I've seen like models with like a fade rate.
That's what a transition period is, right? A fade rate is basically my return on capital is 25%. I think it's going to go to 10%.
Right.
I can't make it go from 25 to 10 in one step. So fade rates are just a fancy word for, and you know what the fade rate usually is, right? Take linear increments every year. So, but they like to use the word fade because you get this idea of people getting together in a committee and they're saying, what's the fade factor going to be? It's one of the most pointless exercises ever. Because your starting number and the ending number, you get somewhere. All my models, I use linear steps because I've discovered that finessing it makes almost no effect on value. But that's all a fade factor is a transition period. So now let's talk about what happens after you're done with your discounted cash flow valuation. So think about it, right? You spent all this time estimating cash flows and you came up with a discount rate. And then you put in a growth period, and you come up with the present value, and you heave a sigh of relief and say, I'm done. And that's when the real mischief begins. So what I'd like to talk about in the next stretch is what people do after they tell you they're done that can create real damage in valuation. So to understand what the next part of the process is going to bring about, do you guys know how academia works? I'll tell you, I have to work really hard, like 4.5 hours a week for like 38 weeks of the year. And they give me only like 17 weeks off. And 38 weeks would be 14, so only 35 weeks. Let's face it, 15-week semesters, really, I work for 30 weeks of the year, 4.5 hours a week. And because I work so hard, every 7th year, it's very biblical, I get the entire year off with pay. It's called a sabbatical. I'm sure you're all heading into jobs which will give you something similar. But that's what my job looks like. So I've had a bunch of sabbaticals over my lifetime because I've been teaching long enough to have generated these sabbaticals. So this is a sabbatical, I think, like 15 years ago, sabbatical years coming up. And most people have big plans for their sabbatical year. They're going to write a bunch of papers, do research. And as I was approaching my sabbatical year, I had a singular objective. I said, I want to wake up for 365 days with nothing to do every day. I'm going to do nothing on my sabbatical. And I admit I got a little ostentatious about this whole process. The first day of my sabbatical, I go to Staples and I buy one of these to-do list boards that you can get. I stay at home. Obviously, I have nothing to do, might as well stay at home. I put that right above my little corner of the house where I have my computer. And as my kids were all at home at that time going to school, came down the stairs, I pointed to my list and kids have nothing to do today. Pissed them off no end. But then they went off to school and I made my fatal mistake. My wife came down the stairs and I said, honey, I have nothing to do today. She said, really? Why don't you take the dog for a walk? So I take the dog for a walk. I come back. There's something on my to-do list. So what is this? Pick up bok choy at the grocery store. I'll be quite honest. I had no idea what bok choy looked like. I was too embarrassed to ask. I walked around like an hour and a half before I found it's like ugly looking cabbage. Tasty, but ugly looking cabbage. I come back home. There's another item on my to-do list. Pick up kids from school. And after about the 3rd or 4th item, I said, I've got to find things to do to keep my wife off my list. I'm really desperate now. Give me something to do. And coincidentally, I get this email from the editor of a magazine called CFA Magazine. Magazine I'd never read, didn't even know existed, never heard of the editor. He says, could you write an article for CFA Magazine? My first reaction is, nothing to do. Why would I do that? But then I remembered I needed things to do. I said, okay. So I put in big letters, write article for CFA Magazine, cannot pick up bok choy kids, et cetera, et cetera, et cetera. And then I did write the article, and I'm telling you, the only thing I've ever written in valuation that's got me hate mail. You know how difficult it is to get hate mail in valuation? Nobody's ever written me, I hate you for using bottom-up betas. They don't feel strongly enough to do it. Or implied equity risk premium. But this one got me hate mail for a couple of reasons. One was the title. It stopped the garnishing. And I was talking about the process of people adding premiums and discounts to a discounted cash flow value. Control premium of 20%, 25%. I said, if you do this, there's no point to valuation because you're going to back into whatever number you wanted by using, I might have used the word arbitrary to describe the premiums and discounts, which pissed a lot of people off. So you get this wave of hate mail. But one of the emails actually, I think, made a good point. They said, if you don't like the way we're dealing with control and illiquidity, why don't you come up with a better way of doing it? Thought about it. You're right. I have 11 months left in my sabbatical. So every month I'm going to take a loose end. something you attach a premium or discount to. I'm going to go to the heart of it and say, if I lived in a world where I had to value controller and liquidity, how would I do? So there went my plan for doing nothing over the sabbatical, but it's now one half of one of my books, the Motor and Valuation. The second half of the book is the result of that sabbatical. So I'm going to take you on a speedy journey through some of these loose ends. I'm going to start with cash. It should be simple, right? I said, don't mess with cash. You have $100 in cash and I ask you, how much is it worth? What's the answer? $100. I'm going to ask a question that I think is a provocative question. You have a company with 100 million in cash. Are there times or conditions where you might discount cash in the hands of a company? And if so, why? Are there times and conditions we might attach a premium to the cash? And if so, why? And I'm going to start with that. Then I'm going to talk about cross holdings, which I call the black hole evaluation, because this is where, you basically give up companies with 20, 30, 40 cross holdings. In a perfect world, how would you value cross holdings? And the world we live in with the information we're giving, how do we make our best shot? I want to talk about subtracting our debt. What's a debt that I should be netting out to get to the value of equity? So I know the answer, but what if your company's target in a lawsuit? Should I bring that into my, because remember, this is your last chance to deal with all the things that worry. We will talk about control and liquidity in a different context. I'm going to talk about control in the context of M&A. But essentially, I'm going to take you through, and one of the things I want to talk about is this sudden surge in stock-based compensation. I'm going to talk about what do you do when you have management options? What do you do when you have restricted stock? Because people just mangle the process with what they're doing right now. So let's start with cash. And I'm going to argue that the way we think about cash is framed by that very start of the class where I said, don't mess with things that are simple to value. So in a discounted cash flow valuation, if you're doing a free cash flow to the firm valuation, what do? We keep cash separate from the operating assets. We look at cash flows from the operating assets. We discount back at a cost of capital for the operating assets. And after we're done, we just add the cash balance. So how big can that be? With Apple, what did I just add to my DCF valuation? $150 billion, right? So this isn't just penny change. This is a lot of money, but the rule is just add the cash balance on. If you do a free cash flow to equity or a dividend discount model valuation, you deal with cash in very strange ways. In a dividend discount model, it doesn't even show up, right? It's there somewhere, but you don't know where, because some of your dividends come from the income from cash. It's giving you more safety. But the bottom line is we're either deal with cash very simply, or we just let it slip into our valuations. So I'm going to show you 3 companies. And I'm going to ask you a question about these companies, which I think is going to cut to the heart of when you might want to discount or add a premium to cash. So the 3 companies are very creatively named: Company A, Company B, and Company C. All have the same enterprise value. So you discount free cash to the firm at the cost of capital, you come up with $1 billion. They all have $100 million in cash. But I'm going to add some additional information about the companies. Company A has a history. So this is not future return. All I can tell you is past return. As a history of taking projects, the return on invested capital of about 10%, its cost of capital is 10%. It is a developed market company. I put it in the US. You're going to wonder why that matters. In the end, I'm going to argue it is going to make a difference. Second company has a history of taking projects that earn a 5% return on capital. Its cost of capital is 10%. It's also a US company. Company C is an Argentine company. Its cost of capital is higher, but it's got really good returns on capital, 22%. I'm going to argue that in one of these 3 companies, cash is going to be a neutral asset. You know what I mean by neutral assets? What we do in all valuation. The 100 million cash is worth 100 million. In one of these 3 companies, you probably should discount the cash. And in one of these 3 companies, you might attach a premium to the cash. Let's start with the easy one. Which of these 3 companies is cash most likely to be a neutral asset? And what is it about A that makes a neutral asset? It's what I call a block company, right? What do block companies do? They don't help you, they don't hurt you, they run in place, they earn the cost of capital. But before you complain about block companies, remember there are fates far worse than investing in a block company. Which of these 3 companies are you most likely to discount the cash, and why? What is it about B that terrifies you? They have a history of stupidity. You know what you're doing? You're attaching a stupidity discount. You're saying, it's not the cash that's going to hurt you. It's what these guys can do with the cash. And what have they shown a history of doing? Screwing it up big time. So you preemptively say, you guys will find a way to screw up the 100 million in cash. So you know what? I'll knock off 25% of the cash. That's probably a sensible thing to do with these companies. Yes, Ed.
This is a broader question. Is there ever a price the company B can be trading at that is worth buying?
In fact, if you assume that they keep earning a 5% return on capital, that 100 million in cash has to be valued at about 50 million because they are building it. So they're valued, if you value the cash at 30 million, you're getting a bargain. So again, there is a way of quantifying the discount but I'm going to give you an easier way to, untrap that discount.
Yeah.
And I'll give you a clue. Carl Icahn does it over and over again. But company C, you might attach a premium. Let's talk about why. If you go back to traditional corporate finance, no company ever needs a cash balance. You know why? Because if you have a great project, what do I assume you can do? Utopian corporate finance, you go out and raise capital. What's the big deal? Just raise the capital. Now, do you see why I put company C in Argentina? 5 times in the last 20 years, the Argentine capital market is completely frozen up. You can't raise equity, you can't borrow money. So the assumption of capital is always easy and accessible. It's gone. Do you see the advantage of having a cash balance in a market like Argentina? Because it's not a question of if there's a crisis. When there's a crisis, you have cash to survive, and it becomes a strategic weapon. You can buy other companies' assets at cents on the dollar. Only mistake I made in this example was making it an Argentine company. I actually did this to a Brazilian audience about 8 years ago. So which company would do discount? To a person, every person in the audience picked company C. And I said, why? You can't trust these Argentines. And it turned out that they lost a soccer game over the weekend or something. There are other things boiling under the surface. But the bottom line is in markets where, and it's not just across markets, right? If I gave you a small company versus a large company, or a private company versus a public company, you can already see the implications. Small companies should build up more cash balances than larger companies because they have less access to capital. Private companies need more liquidity than public companies because it's not like you can go out and issue 100 million shares. Now you're probably saying, do markets actually discriminate across companies? I'm going to argue that they do, but let's be very clear. The discount we're applying to company B is not because it has cash. Because Albert Einstein say cash is a bad asset. You know what the argument is, right? Cash earns only 4%. Right now, that's pretty close to what it'll earn. And I can make my cost of capital is 8%. I've actually seen equity research analysts compare the return on cash to the cost of capital for a company and argue that cash is a value destroying asset. What principle in corporate finance are they violating when they do that? Because then capital's cash is really value destroying. They're $150 billion. I guarantee you, they're not earning anything close to the cost of capital. Right now, they're earning probably 4.8%, which is the T-bill rate. What's the rule in capital budgeting? When you look at the discount rate for an asset, it should reflect the riskiness of that asset. Cash is a riskless liquid asset, and guess what it should earn? 4.8%. Think about what you can earn if you bought a T-bill today. That's close to what you should expect cash to earn. That's not the reason we're discounting cash. In fact, if these managers could guarantee me contractually that they will never touch the cash, I would take the discount away. So let's look at the actual evidence to see if markets are that discriminating. This is actually one of the most creative papers I've read. I don't read much academic research because most of it I don't see the point of what question they're asking and who should care. This paper actually looked at what $1 in cash is valued in the hands of a company by the market. And the way they did this was they took all publicly traded companies and they ran a very simple regression, market value against the cash balance, and they looked at the coefficient of the cash balance. So if cash is valued in $1, you should get a coefficient of roughly 1 on the cash balance. I'll give you the good news. Across all publicly traded companies, $1 in cash is valued at roughly $1. You know why this is good news? Because this is what we do in every valuation. But here's the bad news. When they looked at a subset of mature companies that earn negative excess returns, you know what that means, right? They're like company B, they have a history of earning less than the cost of capital. $1 in cash is valued at 69 cents. That's a 31% discount on the cash. That's an astounding discount. You have 10 billion, I act like you have only 6.9 billion. If you were advising this company, they said, how do I make my market price go up? The advice is very simple, right? What should you do? Just give the damn cash back. You know how much they'll resist you? No, we've changed. Doesn't matter. Markets don't trust you. Give the cash back. The discount will disappear. But they will refuse. And that's where a Carl Icahn steps in. Carl Icahn is a one-trick pony. He looks at a company. You have too much cash. Give me the cash. You say, how much value is that? You pick a company like this one. You target the company and they return the cash. That 31% discount. You don't need to change the way they run the business or change the debt ratio. All you need to do is get rid of that cash balance because people don't trust you. That's is going to come from outside because managers left to themselves don't want to give up cash. They control the cash. They can do things with it. You need almost outside pressure on these companies to kind of say, you know what, your best days are behind you. You need Larry the liquidator saying, just give the cash back. And if you look at high growth companies that are well above their cost of capital, $1 in cash is valued at $1.22. There is an advantage to young companies, money losing companies, to have a cash balance. Remember that failure rate that I asked you for your company? That failure rate is partly determined by how much cash you have. The day Paytm and Zomato and Airbnb did their IPOs, their failure rate dropped dramatically. You know why? Because they raised cash, they put it as a cash balance. They added $3 billion in cash. You have enough cash now to cover the next 4 years. You've reduced your failure rate. That's why going public can overnight reduce your failure rate. It's not because there's something magical, but because you've augmented your cash balance. So cash should be the easiest of assets, and already I've added some twist to it. So don't do anything weird right now by taking your cash balance and discounting it, but think about it as you go through. If you have a company that gets 30% of its value from cash, it's worth thinking. Now, staying on this theme of simple to value assets. Most companies, the trouble you run into is they're technology companies or manufacturing companies. You've got to project cash flows, you've got to value the company. But you know what a closed-end mutual fund is? A typical mutual fund is an open-end fund, which means that if you send your money into Fidelity Magellan, the number of units in the fund increases, your net asset value is going to be whatever the value of the fund is divided by the number of units. So in an open-end fund, what the net asset value of your holding is exactly equal to what the fund is invested in. A closed-end fund is actually a publicly traded company. And what makes it unique is that the assets are all shares in other publicly traded companies. So if I bought shares in 10 companies, those are the odds. It should be the easiest of all companies to value, right? Just add up the market cap. And you'd expect these companies to trade at roughly close to that number. It's so easy to value them. But a typical closed-end fund trades at about a 15% discount on the market value. In fact, when the first papers written on closed-end funds, it was called the closed-end fund puzzle. You know why the word puzzle is thrown in, right? Because there seems to be an easy arbitrage opportunity, which is to do what? Buy the entire closed-end fund for 85% of the value, liquidate it, and keep the extra 15%.
You just change the open-end fund.
You can change it to an open-end fund and the discount should disappear. And there are some closed-end funds, 15% of funds, where that happens every year. But the other 85%, because of the way governance is set up, or taxes, because remember, you sell the stocks you don't get to keep the entire amount, you still have to pay taxes. There are frictions. But the question is, why do they trade at a discount? I think the answer is already there, right? Why did we discount Company B's cash? Because we didn't think they could earn what they needed to make. If you put your money in a mutual fund, what's your expected return? What do you expect the fund to make? Let's say it's a fund that invests in large market cap companies. It invested roughly what the S&P 500 makes, right? In other words, if you're a value investor, there's a value index fund that I can use. Basically, And we know that if you look at the history of active money managers, they've had a tough time earning that required rate of return. The typical active money manager underperforms the index by about 1.5%. So when you put your money in a closed-end fund, you know what you're doing, right? You're effectively saying, hey, I'm going to make 1.5% less than I should make. So if my cost of equity is like 11.5%, and I think you're going to make only 11%. Think of what that translates into. Because you're going to make 0.5% less. I'm going to discount your funds, just like I discounted cash for the fact that you will not earn what you need to do. And the worse I expect a fund to do, the bigger the discount is going to be. So if you look across closed-end funds, about 20% traded premiums, 80% traded discounts, and the discounts can be as large as 40 to 45% for some, which are usually, headquartered in the Cayman Islands or someplace where governance is really messy, and they have a history of underperforming markets. So if you get a chance, pull up 10 closed-end funds, look at their history, look at the discount. I'll wager funds which have a history of underperforming are the ones that trade at the biggest discount. But if you have a closed-end fund that beats the market, you know what you're going to do, right? If you expect it to keep beating the market, you're going to actually trade at a premium over there. And I'm going to use a company that you don't think of when you think of closed-end funds to illustrate this process. We mystify Berkshire Hathaway, partly because of Warren Buffett's place in it. But let's think of basically what Berkshire Hathaway is. It's an insurance company that collects premiums, and those premiums get invested in a bunch of companies. This is true for every insurance company. Every insurance company has an insurance business part and a mutual fund part, basically a closed-end fund on the other side. In most insurance companies, it's the insurance part that drives value. If you're Allstate, you basically say, if you're a good insurance company, I'm going to give you a premium. But on the fund side, you expect them to kind of match the market. They're nothing special. But Berkshire Hathaway is an insurance company that is the best regarded fund manager in history running the closed-end. You know what this is going to create, right? Historically, if you look at Berkshire Hathaway, you look at the book value of Berkshire Hathaway. The reason for a long time, Berkshire Hathaway used to report book value. Book value of Berkshire Hathaway is just market value of companies. So Coca-Cola, it's mark to market. Berkshire Hathaway used to trade at 2.5 to 3 times book value. I used to tell people, you buy Berkshire Hathaway, you're buying Coca-Cola at 3 times the market price, right? That's effectively what you're doing. But you're doing it, why? Because Warren Buffett is there. He's going to keep picking great companies. So I'm going to show you a graph that kind of captures what's happened to Berkshire Hathaway over the last 20 years. You look until the late 90s, Berkshire Hathaway trades at a premium. So the price to book ratio of Berkshire Hathaway much higher than the typical insurance company. But over the last 20 years, if you look at what's happened to the company, it's become more like a typical insurance company. The premium seems to have disappeared. Why? Good.
The introduction of the B share.
That I think nobody even, it was Buffett. He can do whatever he wants. People don't even think about it, the ulterior motive. So I remember when he introduced the B shares, people said, oh, it's Buffett. He must have a good reason for doing it. It's not the buybacks, which even
Too much money to invest.
it's been big for a while, right? You're right. It's getting bigger. That scaling is working.
I'm saying basically the
How
market.
old? No, there's probably a very simple. How old is Warren Buffett now? Will he die one day? I'm not being morbid here. I think he will, right? You know what's happening? Markets are not stupid. They're looking at a 91-year-old and a 97-year-old on the stage, Charlie Munger and Buffett, and saying, you know what? This too shall pass. The discount reflects it. In fact, a decade ago, Buffett actually officially said he wasn't going to pick companies anymore. He hired these 2 guys and he said, nobody ever hears from them. Todd Combs, I mean, I never see his name in the news. He's not on the Buffett premium is unique. You can't pass it on just because you say, I picked a good guy. It's just the aging. There are lots of other issues. I think value investing itself has hit some crossroads. But what you're seeing there is a reflection of the expectation of there is no Buffett premium left because he's not going to be around for much longer. When we think about personality-driven companies, we think about Musk and Tesla. But the reality is Berkshire Hathaway, because of the nature of its business, has always been built around Buffett. That's the premium that you're getting on the closed-end fund. That premium is now gone. Berkshire Hathaway is a very good insurance company, and it's a decently run closed-end fund, but it's not special anymore. So that's the cash part. Let's move on to cross holdings. Cross holdings, test your accounting. Because the way accountants treat cross holdings, it's all over the place. Broadly speaking, a cross holding can be classified into one of three groups. It can be a minority passive investment. What's a minority passive investment? You own 3, 4, 5% of a company, and you take no role in how the company is run. Basically, it's just a holding. You can have a minority active investment. You own 15% of a company, you have somebody in the board of directors, you have some role in how the company is run, or you have a majority holding where you own 60% of a company. You know how the accounting works? If you have a minority passive investment, all you have to show is the dividends you receive from that investment as part of your income statement. Let me repeat that again. The dividends you receive. And what you have to show on the balance sheet is what you originally invested to get that holding, to show you how disconnected this can be from reality. I remember an older version of SoftBank in the 1990s, which at one point in time got 50% of its value from one holding, a holding in Yahoo, because they were an early venture capitalist in Yahoo. It was almost 50% of the value of SoftBank. If you looked at SoftBank's income statement, though, because it was classified as a minority passive investment, you know what you'd have seen? How much did Yahoo pay as dividends in the 1990s? Zero. You'd have seen nothing. You see, that's okay. I'll see it in the balance sheet. You'd have seen the $50 million they originally invested for a $7 billion holding. Minority passive as uncommon. Thank God for that. But it's completely disconnected from reality. Then you have minority active holdings. Minority active holdings, you take a stake in the company, you have some role in how the company is run. You've got to use what's called the equity approach. This is the predominant approach that most companies do with cross holdings. An equity approach, in your income statement, you have to show 15% of the net income or net loss from the holding, better than dividends at least. And in your balance sheet, you have to take your original investment and adjust it for retained. It's like an updated book value to reflect what's happened since. A little better than mine. And then you get to majority holdings, accountants flip out. You own 60% of another company. What are you required to do in both IFRS and GAAP? Consolidate. I've never understood the logic of this. What does consolidation mean? When you do revenues, you've got to act like you have 100% of the subsidiaries revenues. You have only 60%. The accountant says, don't worry about it. Your operating income, 100% of the operating income, only 60%. Don't worry about it. Then you get to the assets. You count 100% of the cash, only 60%. The accountant says, don't worry about it. Then at the very end of the process, the accountant wakes up and says, you own only 60%. I said, that's what I've been trying to tell you all this time. You don't own 40%. Genius. We've got to show the 40% that doesn't belong to you. And hence is born one of the worst named items on the balance sheet. It's called minority interest or non-consolidated interest. What does it capture? It captures the 40% that doesn't belong to you, but it shows up as a liability. Why? Because you counted 100%. You're trying to fix your problem. Already you can see the first step in dealing with cross holdings is you got to understand the accounting, because now you've added layers of choices. Joint ventures, some of them now allow partial consolidation, which means you go on 55%. You can, in some companies, you mark to market. SoftBank now has to mark to market because it's viewed as holding these companies for trading, but Microsoft doesn't. The first step in dealing with cross holdings is going through the accounting and trying to figure out how exactly are these people estimating the value of cross holding. And in a perfect world, let's talk about how you value cross holdings. In a perfect world where you were doing things from scratch, here's what I would do. I'd value the parent company standing alone. Take out all the cross holdings. That way I can give it the growth, the cash flows. I can focus on the parent company. Then I'll take each subsidiary, it doesn't matter whether it's minority or majority, value that subsidiary from scratch with its own cash flows, growth, and risk. And then count the percentage of each one that belongs to it. So the ultimate valuation would be the value of the parent company plus 3% of company subsidiary B, plus 7% of subsidiary C, plus 60% of subsidiary. You see the advantage of doing this? You're treating each company individually, you're not consolidating them, you're giving them each their own cash flows, growth, and risk. You can do each one in a different currency, right? One can be US, one can be Japanese company. You're not trying to do it all in one currency. But it does require information. What's the information you need? You need information on your company's parent company status. Many multinationals would report both a parent and a consolidated, but some report only consolidated. You don't even have a choice. But you also need full financials on every subsidiary that you have. But here's the problem you're going to face. That's not going to be easy to get most companies. I'll tell you a story to illustrate how messy cross holdings can be. In the late 90s, I was valuing a Japanese company for one of my valuation books. And at that time, valuing a Japanese company, we were always teetering on the edge of disaster because Japanese yen risk-free rate was so much lower than rates elsewhere in the world that you had to be careful about the growth rate. So I was being careful. I finished. I'm patting myself on the back for a job well done. When I take a look at the company's financials, and they report they have 227 cross holdings. Remind me again, to value this company, what do I need to do? I need to value 227 other companies. I am way too lazy. This is the kind of company I say, look, I'm not investing in the company. It's too much work to do. But let's say I'm not a lazy person, that I'm willing to take the path of, I couldn't have done it in this company for a simple reason. 60 of the 227 companies were publicly traded. So I could get the financials. The other 167 were private companies with zero information provided at any of the operating plans, no revenues, no operating income, nothing. So I called the investment relations officer of this Japanese company. She's very polite, as Japanese I want to be, but completely opaque. So I said, look, I'm valuing the company. It's not for an expose. I would like some information on the cross holding. She said, I cannot give you that information. It is proprietary. The way she said proprietary was kind of scary. I said, okay. What if I bought 1,000 shares in your company and then called you? She said, it'd still be proprietary. I said, that doesn't make any sense to me. 1,000 shares, I'm part owner of your company. You're refusing to tell me what I own. She thought about it for a moment. She said, you have a point, but it's still proprietary. At this point, I'm banging my head against the wall. I'm ready to hang up the phone. She said, wait, I can tell you something about these cross holdings. I'm expecting something like revenues or operating income. I said, what? She said, I cannot give you specifics, but they're worth a lot. I said, I'm sitting here with an Excel spreadsheet with a cell next to cross holdings. I'm trying to enter LOT, but I keep getting error messages below. How many zeros are there in a lot? But this cuts to the heart of the cross-holding culture, right? Which is, what do managers want to do? They want to hold up a brown paper bag and they trust me, it's full of cash. Can I look in the bag? No, it's full of cash. I'll tell you exactly how much. Take my word for it. And as long as we take their word for it, why are they ever going to let you look in the bag? We get the companies we deserve. So when I hear investors in some markets saying, companies in my market, they have cross holdings, they won't tell it. You know, easy way to make them reveal what the cross holdings are? Give the cross holdings a value of 0. You know what that's going to do? It's going to smoke out the people with valuable cross holdings and no, my cross holdings are not worth 0. Here, I'll show you what they're worth. But as long as we say, I'll take whatever you show on your balance sheet, the valuable cross holdings, we're not going to get the information. But in a perfect world, let's see how this would work out. So this was a few years ago when Yahoo was still an operating company. If you remember 2013, 14, it was towards the end of its life. Marissa Mayer had just come in as CEO. She was going to rescue the company because of her days at Google. I decided to do an intrinsic valuation of the company. And what made Yahoo unique is by the time you got to 2014, there was a Yahoo, the operating company, which operated a search engine that nobody searched on and an email program that nobody used. No. So basically, the company was reaching the end of its life, but it had 2 crosswords. One was in Yahoo Japan, which for whatever reason, the Japanese like to use Yahoo is still operating as a lucrative business and as a standalone company with its own financials. And the other, of course, was an investment that Yahoo made a decade earlier in a company called Alibaba. In 2014, as you know, Alibaba went public as a $200 billion company. So I valued each piece separately, and I was able to do this because Yahoo was a standalone company. I was able to get the parent numbers. Yahoo Japan was a standalone Japanese listing. I was able to, and this was right after Alibaba filed for their IPO. So the prospectus was out. So I did an intrinsic valuation of each of the 3 companies. So I'm valuing 3 companies to get the value 1. So each one I value the operating assets, I had cash, subtract out that, that's Yahoo's parent equity, 7.4 billion. I get the value of equity in Yahoo Japan, 21 billion, 35% of that. And Alibaba, I did an intrinsic valuation in this was before the IPO, there was no market price, 22.1%. Add the three numbers up, I get it. The one caveat here is if Yahoo sells its Alibaba holding, which was required to do because of the agreement they had with Alibaba, there would be a capital gain. So I factored that in saying, look, if I'm going to count that as part of my value, I've got to factor in that the day after they go public, there's going to be a sale. That's a $5 billion taxes due. But this is an intrinsic valuation all the way through. I'm valuing the parent company and valuing the subsidiary, but I'm able to do it because I have the financials. This is the exception, not the rule. Most of the time, you're going to be able to get only some of the information. You get the parent company, but not the subsidiaries. And the question is, what do we do in the limited information that we have? And I'll give you two choices. One is so I would do this for both minority and majority holdings, is if you have publicly traded companies, the 60, let's go back to the example of the Japanese company, 227 cross holdings. Let's say I'm too lazy or don't have the information to value all 227. For the 60 publicly traded companies, what's an escape hatch I can use? Just take the market price, add it on. I'm cheating, right? Because I'm adding a pricing to an intrinsic valuation, but I'm saying, look at how much work it saves. And for the other 167 companies where I have only a book value, I can try to convert it to a market value if I know what sectors you're in. If you're a chemical company, and a typical chemical company trades at what? It's very sloppy. It's a pricing, but it's better than just taking book value. I'll take a pricing over a book value every single time. So the fact is, when you look at these companies and you try to value them, you got to work with the information you have. And with Yahoo, I actually did a pricing alternative. So here's what the pricing alternative looks like. Rather than do an intrinsic valuation of each part, I applied a multiple in each part. So I used EV to sales for each of the companies and adjusted for the fact that growth was different. And here I'm doing a pricing of the parent company, the subsidiaries. Most of the time when people talk about doing some of the parts valuation, they're doing some of the parts pricing. Very few analysts actually do a full-fledged valuation, but I'm still trying to bring the parts in to my final valuation. So I'm going to stop with that. And when we come back after the break, we're going to continue with the loose ends. But you have all the ingredients to do your intrinsic valuation. If you have time on your hands, especially in the next couple of days, you want to get something started. I would strongly recommend getting started. That's the toughest part. If you don't get started, you can never get done. I'm stating the obvious. Get started. If you get stuck, at least you know what you're stuck on, and you can think about what you do when you get back. So have a great break. I will see you when you come back on Monday, a week from Monday. And I will give you a break on emails. My last email will come on Friday, and for a whole week, you will not hear from me. I promise you. But wait for the email a week from Friday because we're back.
I've got no other friends. I'm gonna miss them. I have a question. When I came to your office hours in person, are you okay? So when did you come? I came about 12:05 today. Yeah. Oh, it's not in your office. Not in your office. That was not this morning.
Okay, because there was somebody in my office. Maybe it was I did because I reached here to 11:50. Okay. So it might have been that I got there, but I thought I got there by 5.
Tomorrow, Friday, before spring break starts.
Yeah, I can do after 5. After 5.
You're gonna do, because you do on Zoom.
Send me a Zoom.
Send you, I'll send you. Thank you.
And then you'd have to no problem. Oh, exactly. But whatever you assume about okay, got to bring into this time into this as well. So if you assume that inflation will go up, it's fine. Do your cash flow, but you can't leave it to 4%, right? The screen rate has to affect whatever inflation. You can't get clear about what you're talking about.
Do you say you have long-term inflation? The United States is 2%.
Valeu, velho. Bom, aproveita a viagem. Do caralho.
I'm just saying, whatever you project out, the risk-free rate used has to be
Depois
consistent.
você passa o roteiro.
Yeah, but I'm saying now, when I get the risk rate, I see like I would assume that risk rate
and inline.
Yeah.
I'm saying that my point is as long as the discrete rate, they got 8% inflation for the next 50 years. Let's say one of the probably projected.
That's different.
So it's got nothing to do with what you project as the inflation, right? It's what the risk-free rate that you're using, the growth rate you're using are internal. You can assume low inflation, you can assume deflation, you can assume high inflation. As long as both those numbers reflect that. Really not going to make much of a difference.
You were saying that you still have to reinvest in the business, right?
That's got nothing to do with inflation.
Yeah, that's what I was. When I thought you were saying that you have to reinvest in that.
But if you have high inflation, then your reinvestment rate will actually reflect the fact that replacing existing equivalent costs you more than the original equipment cost. So basically, if you use an 8% growth rate, now it argues because of inflation.
Yeah.
Your reinvestment rate is like, even though your capacity is not changing, maintaining capacity is going to cost you more and more of that.
But all of that would be accounted for in the cash flow because then your probably revenues would also be going faster.
Well, you know, all of it is, it will also be a higher rate, an 8% inflation rate. So when you say all of that,
But I'm saying in terms of cash flow,
Yeah.
your reinvestment is higher, but the income is also going to be higher just because the price have gone up because of inflation. Right? Okay.
Two things.
Yeah.
I want to tell you that there are flows and fund arbitrage in existence that
They
speak
probably-
to.
there are about 20% of closed-end funds every year are targeted for on closing, if you don't make an opening of a liquidation.
Exactly,
Hmm.
exactly.
And it's easier in some markets than others,
Yes,
but I think you're absolutely right. That's the stress you create when you discount something where you can observe what you own and you're trading at a 20% discount. on it. There are closed-end arbitrage funds. The puzzle is that they don't succeed more often. Right? Because you'd expect this should be a slam dunk, 80%.
the government,
But if you think about this persistence of closed-end funds, in reality, closed-end funds which have been discounted, the closed-end funds that have been discounted for the last 30 years. A lot of real estate closed-end funds traded big discounts
Mhm.
on the property. The problem there is liquidating the assets is going to be really difficult to do. So you can buy the fund, but then you're not selling stocks, you're actually selling real estate properties that you think are worth more than what you paid. But if 5 properties are in the same city, then you're trying to sell them all at the same time. Who knows what kind of discount you'll have to get. But it is a constant push and pull. But to me, the puzzle is why so many of them continue to live in spite of all these people trying to discount them. And the answer has to be it has to be governance or taxes. Right?
the most interesting one was Third Point. It
Mhm.
has a listed fund in London.
Yep.
And it trades at a perennial gap. And because Dan Loeb is out there, after this, blah, blah, blah. It was just so interesting to see an activist investor target the closed-end fund and like, haha, the pot calling the kettle black. I thought that was very interesting.
Somebody should target his fund.
They did it. They did. It was in the FT like a while back.
I'll check it. That's an interesting story.
The other thing I want to let you know is that I'm going into the insurance business.
It's my business to be in, but you know, as I said, in every insurance, are you going to go into the fund side or the insurance?
The fund side. I would prefer to be on the insurance, like managing the.
Then all I would say is obey the Hippocratic oath. Do no harm. Don't try too hard. I'm serious.
Okay,
Not because, let's face it, insurance companies' core value comes from the insurance business.
yes,
And the Berkshire Hathaway is an exception to that rule.
yes,
I think when insurance companies get hurt, it's because people on the fund side try too hard. They want to be what I've Warren Buffett. They're reaching, they're overreaching, they're over-investing, they're concentrating, they're making big bets on, moonshots. You gotta be very careful. If you're an insurance company, your portfolio, I pay you for consistency and being close to the market and keeping your costs low. Not for going into alternative asset classes and unfortunately, insurance companies are not immune from the kinds of pressure. Everybody's investing in cryptos and they claim to be making a lot of money. You see pressures building up within these companies. We got to do that too.
okay,
So I think my advice is, remember, it's an insurance company fundamentally, and your job is to preserve those premiums first. It's
Mhm.
very much of a, preserve premium, and you want, of course, deliver solid returns. And if you can make 20 basis points more than market, you're a hero, right?
that's the hope. I hope to get my offer by the end of the month. We shall see.
Good.
All right,
Good luck to you.
take care.
Hey, how are you?
Hi.
I'm glad you made it to the class.
Thank you for having me.
You're welcome.
Really, yeah, it's a wonderful class and.
Thank you.
It's wonderful too. I also brought you a small present. And some Belgian chocolate. Not to say thank you for the class today, but thank you actually for all the YouTube video that you
Thank
make,
you.
because
You're welcome.
they have a large impact across the globe, you know that.
Thank you.
Right.
Appreciate it.
Thank you.
Take care.
Okay.
Bye-bye.
Yeah, how are you?